Today I am going over exactly what Dave Ramsey has been saying to everyone that's worried during this potential market crash. And then also I just wanted to kind of talk about what I'm doing and how it's pretty related to Dave Ramsey. So he lays out in this video exactly what he thinks about the market crash, and I think it's pretty right on. Before we go into that though, I want to apologize, or not apologize, but I want to say to everyone that is either been laid off or that has been affected by someone with corona, that I hope you guys get through it. Just like everything, it will pass, but I know that sucks in the short term a lot of the time. So first off, if you are laid off or you don't have an emergency fund, I'd say don't do what I'm doing. But just try to get that in place first, because obviously the well-being of your family and yourself comes before investing. But Dave Ramsey has a good reaction video here about kind of going through what everyone's thinking. And in the first 3 minutes here, he talks about when he was younger, they used to have price wars or oil wars, gas wars in his hometown, where one gas station would start lowering their gas and then the other gas station would lower theirs, back and forth. And they would have this war where they went back and forth to see how low they could get their gas, and then everyone kind of won in the short term because they got cheap gas. But then eventually the gas stations would get annoyed with it and just raise their gas back up to the normal price. So he's describing how that is what's happening with the oil wars right now. So I kind of agree. There's a stalemate where one country wants to raise or lower the price of gas to drown out the price of the other one, and make them, hurt in the short term, but eventually it'll go back to normal. So he also talks about how that is driving the S&P 500 down, and I'll show you what he says after that. But that was just the first 3 minutes. It's just a long 3 minutes to go through that, so I'll show you the next part here.
Oh, let's mix that with all of you people have completely lost your mind over the coronavirus, and everybody's scared out of their brains and can't even think clearly now. Oh, and now we have...
So this is from 2 weeks ago. So there has been some new information coming out. It's gotten much more serious, I think, in the last couple weeks. So just keep that in mind. But keep playing it here.
A wonderful buying opportunity on the stock market today. The stock market is tanked based on this oil war and the coronavirus. Now, let me help you with this. My friend Art Laffer, who is one of the leading economists in the world, without a doubt, has a great saying. He says people don't make good decisions when they're drunk, and they don't make good decisions when they're panicked. If you're thinking about pulling your money out of the stock market because you think the coronavirus is going to destroy the U.S. economy, you are a panicked fool.
So I agree with this. I haven't really talked to too many people that have been panicking and taking their money out of the S&P 500 or out of the stock market. But I have talked to a lot of people that think that they're smart enough to time it and take out their cash and then reinvest it, which if you did this a month ago, right before the crash or right when it started, I think, that's fine. It's kind of a risky thing to do, but it could pay off. But if that was me, I would be putting it back in now. I would have taken it out and then started to put it back in, dollar cost averaging back down, because I don't know when the bottom is going to be. And it's risky to leave it out right now, because even in just one day, the stock market can go up 10%. So if you take it out and you don't put it back in on one day, you could lose 10% increase. So it's very risky right now. It's not like we're slowly edging down and then slowly coming back up. There are big shifts right now. But he goes through it a little bit more here, and I'll play it.
You're a fool. Southwest Air's stock price is down 30%. Do you think Southwest Air has lost 30% of its value because of the coronavirus in reality? I mean, learn to do a little basic math here.
So he starts to go off on a tangent a little bit there, but I agree with what he's saying. That was the whole premise behind why I started investing extra money that I had that I was going to start saving for a house, because these stocks are going down massively. We're not talking about a 5 or 10% dip. We're talking about 30, 40, 50, 60, 70, 80% in some of these stocks. And while I think that they might even lose money in the short term, I don't think any of the stocks that I'm investing in are going to go out of business. So when Delta goes down 60%, they might have a down quarter where they don't pay me anything. It might go down another 50%, but I don't think that they lose 50% of their value as a company with the stock price. I think that maybe they get, especially if you're talking about a 5 to 10 year timeline, which is kind of what I'm looking at. Of course, I'm going to be invested longer than that, but 5 to 10 years, I might pull my money out of Delta. I don't know. But I don't think in the next 10 years they are losing 60% of their profits over the next 10 years because of the coronavirus. I don't think that they got 60% cheaper and can only make 40% of what they were going to make because of this. So that is how I looked at it too. I hadn't seen this Dave Ramsey video at the time, and I started investing actually before he put out this video, some extra money, but that's exactly my thought process behind it also. Just put a little bit here, and then I want to go through the stocks that I have and kind of how I've changed, how I've been investing over the last couple weeks since my last video.
Means that throughout the next 5 years, their rides on their planes would have to be down 30% for them to have permanently lost 30% of their value.
They've lost a lot more since then.
That's asinine. You're panicked or you're drunk. I don't know which it is, or both.
Panic.
That's ridiculous. And so the stock market going down is as artificial as it can be. It is based on drunk people, panicked people, and an oil war.
Yeah, so I agree with that. Again, I'm just saying I agree at everything. I usually don't agree with Dave Ramsey this much. But another good representation of what's happening I've heard before is if you go to the grocery store and I've always used toilet paper, which is ironic now because toilet paper is crazy right now. But let's say you buy a sweatshirt and you buy it for, you have 50% off, right? So you go there, you're going to pay $30 for the sweatshirt. Now it's only $15. You didn't know about that. But now you're definitely going to get it because it's a great value. So you buy it for $15. Let's say you go back 2 days later and it now is only $10. Are you going to be pissed off that you bought it? Well, maybe a little bit, but in the long term, it doesn't really matter. It was a great value, and it was a lot less than what you were going to pay for it. So you don't go in there on the day that's 50% off and say, I wonder if it will be an extra 10% off or 20% off tomorrow. No, it's something that you need, and it's something that you were going to get anyways, and now you just get a better value. So there are very few things that we go and get that are like this, where we are so worried about what it's going to do in the future, whether it will go up or go down, that it almost freezes us from buying it, because that just doesn't happen in our daily life too often. I mean, sure, we might wait for a sale, but after there's a sale, we buy whatever we want because we wanted it. So it's kind of interesting in that way. But I want to show you this video. I agreed with a lot of what Dave Ramsey said here. I think he pretty much hit the nail on the head here, that people aren't being irrational in their fear necessarily of what's happening health-wise, but they're being irrational with how they're investing. I think a lot of people are just pulling their money completely. He goes through that later in this video, talking about how if you're pulling your money out of the market, you're thinking too short term. That's not wise, and that you should keep your money in because it will rebound in just a little while. So I completely believe the same thing. So in my last video, I'll pull it up here, I was showing exactly how I was investing in this M1 portfolio, and I have changed up my allocation, my targets for these different slices quite a lot actually since last video. My last video was made almost 2 weeks ago now, about a week and a half now. So back in this video, I had a large slice devoted to the S&P 500 index. Part of that was I was pretty uncomfortable investing in individual stocks back then. I hadn't ever done that besides just my company stock purchase plan. So it took a little while to get my feet wet and feel good about the companies that I was investing in, and to feel like I was willing to take a little bit more risk investing in individual stocks. That was something I never planned on doing. I planned on investing in index funds the whole way. And I think that's really good for the way up when the stock market's going up, because it diversifies your risk. And I don't really know necessarily what companies are going to do in the future. I can make pretty educated guesses, but the difference is when companies go down, if I don't think that their company is going to go out of business and they have a strong balance sheet and they're going down in an irrational amount of time, or an unlikely amount of time, a short amount of time, and I still feel good about their business model, I don't care if they make $0 in the short term if they are a good company over the long term. And if a company goes down 60, 70% and the S&P 500 goes down only 30 to 40%, I'll probably invest in that company, which is what has been happening. Of course, there's more risk when you do this, but I'm not looking at $300,000, $400,000. I'm investing $4,000 now. I've invested $4,800 now, and I plan on investing another $3,000 to $4,000. So it's not a huge risk. I still have a lot of money in index funds. I'd say 70 to 75% of my money is in index funds still. And this is a smaller portfolio, but I think I can take advantage of some of the dips in the market here. So going through the last video, S&P 500 was about 25% of my portfolio, actually 27, but the target was 25. Berkshire Hathaway target was 12%. VNQ, which is an index for REITs, so real estate investment trusts, companies that own a lot of real estate, I was putting at 10%. Delta Airlines, 10%, and I have decreased that, but I'll show you here. Carnival, 8%. IIPR, which invests in real estate from groceries, they were at 4%. Foot Locker, 5%. JP Morgan, 5%. NRZ, 5%. Royal Caribbean, 4%. NRZ is a mortgage REIT, by the way, so they invest in mortgages. Then Comerica stock, regional bank, Amazon stock, 2%, Facebook, 7% was my target. I just increased that from, I think, 2%. And then I think Disney is my last one, which is 2%. So in this video, I believe it was 12 holdings, with the most significant one being the S&P 500, which holds 500 companies. And then I've changed it over time. I'll show you here. I've decreased my risk a little bit in Carnival and Delta. I haven't sold any of that. And I got out of the Royal Caribbean before it dropped a lot more. That wasn't on purpose, but I was learning how to use the platform, and I set the allocation to 0, and it sold all of it. I thought if I set the allocation to 0, it just wouldn't buy anymore. But I've just learned how to use the platform better. But I think I sold the $100 worth that I had there by accident. Just stopped recording all of a sudden. So what I was saying was I am lucky that I am in an industry, which is banking, that is pretty resilient to everything that's going on right now. I think it is considered an essential business, so I'm not too worried about a job layoff or anything like that. But I still have money coming in. They told us that even if we didn't work, we'd still get paid the same amount throughout this time. There is some level of knowledge that is required for this job, and we have to go through about 2 months of training before we can perform it. So it's pretty hard to get into banking at the beginning, just because it's not a job that you can just pick up after a day of training. So they want to keep us for the most part. So I can still contribute to this, but it's just going to be slower than it was before. So my first and biggest holding is Facebook. So I have been feeling really good about Facebook. They have a ton of reserves, and they still make a good amount of money. I think they'll do, decently well, better than most companies through this recession. People are at home. They still are going through Facebook. There's still ads. So I think that they'll do pretty well overall throughout this. So they're my biggest holding. I think that they're severely undervalued. They also own Instagram, and there really hasn't been any monetization of Instagram yet. It doesn't have ads to the level that Facebook or YouTube or anything like that online has ads. I think that they can implement that and make a lot of money from it. Instagram still has a lot of room to grow, I think, and they are very popular on people, that aren't 50 or above. Some older people still have it, but a lot of people that I know like Instagram more than Facebook. So that's why they're my largest holding. They're at really low prices right now too. They don't pay a dividend, but I think that they maybe will in the future, kind of like some of the other big tech companies have started to pay 1 to 2 to 3% dividends. I think that they'll maybe get into that in the next couple years. Most of my businesses here have dividends, but actually the 3 largest don't really have dividends, but a lot of the smaller ones in my portfolio do. I still have a good amount of the S&P 500 index. I haven't bought any more, and I haven't sold any since the last video. The target weighting I have brought down to 1% just to keep it around, and my actual weighting is 14.5%. It's just slowly been going down, and as I've been investing more into this portfolio. So I think it diversifies me well, but at this point I want to buy these other companies more than I want to buy the S&P 500. I still invest in the S&P 500 as it's going down in all my other accounts, so I am okay with not putting more money in that here. Another great company is Berkshire Hathaway. I've increased my position to 11%. I don't remember what it was in that last video. I think it was around this, but I think they're a great company. I think that they will do well throughout the recession, or at least after the recession, because they'll be able to pick up some really good deals on stocks. They have a lot of cash. About 25 to 30% of their company is cash at this point, actually before this recession hit, so it might even be a larger percentage now. They had about 125 or 130 billion dollars in cash. So I think that they'll be able to do really well in this, because they'll actually be able to pick up some deals and possibly come out this stronger than ever. The next stock is Foot Locker. I think I had in the last video, but I've increased my position. They're a company that owns more than just Foot Locker. They own Champs, they own East Bay. Those are 2 pretty big companies in that athletic space, especially East Bay. I know a lot of people that use East Bay. And if you're not an athlete, you might not even know what it is, but they sell pretty much everything that you'd want athletics-wise on their website and in their catalog, and a lot of athletes like using it. I think that they'll still do decently well. I think that they'll come out of this and pick up right where they left off, because if a lot of athletes aren't playing sports right now, they're not going to make that much money right now, but then as soon as they come back, a lot of people will want new stuff. A lot of people will have waited 3-4 months, maybe just 2 months since they last played, and will want new gear. Their parents haven't spent money, so why not? And then they'll do quite well over the long term. They also have a good amount of cash. They have a really low price to earnings ratio right now, so I think they're a really good deal. VNQ, I had this in the last one too, but they're going to be one of my larger holdings. They are that real estate investment index, so I think that they're going to do well over the long term. They pay pretty well, or pretty high dividends, and they've gone down 40% since the market crash. I think that it diversifies the portfolio into real estate a little bit better. This is the IIPR stock that I had invested in before. They invest in the real estate that groceries use. It has a lot of growth still. They've increased their company so much in the last 3 or 4 years. I think that they're going to do quite well. A lot of their leases are long-term leases, 10, 15, 20-year leases. So unless the groceries just go out of business, which I think is why they're being priced down right now, they'll do quite well, and they have a lot of room to grow still, especially if legislation changes in some states and makes it easier for groceries to make money. SPHD is a new company that I hadn't invested in before, or a new fund. It holds some of the highest yielding S&P 500 index companies, the highest dividend yields, and then it takes out the most volatile. So the ones that fluctuate the most in price are taken out, and then it just gives you the highest dividend earners. So I think that the dividends will go down in this index because a lot of companies will be hit hard throughout the recession, but then it'll come back strong. It holds, I think, 50 holdings, 47 holdings, something like that, and it pays monthly. So I think it will be nice to get that dividend yield in my portfolio. It will be about 0.5%. 0.5% of this amount here will be in a dividend every month, and it just goes up as the price goes down. So I'm happy with that. I think that it's a good way to diversify again, since I'm becoming less diversified as time goes on, and it pays high dividends there. JP Morgan, it is one of the largest banks. It has a good dividend yield here. It's a really solid bank, and I think they'll do well throughout the recession, and especially after, once they start increasing interest rates. Qualcomm, I don't know if I had this in my last one, honestly. I think I started investing in it about 2 weeks ago. They're a big 5G play. A lot of companies are going to 5G, and I think will do quite well after we start transitioning and people need 5G for a lot more things, self-driving cars, new phones, stuff like that. I think that will become the new standard. Carnival, I went down from 8 or 10% in the last video to about 5%. I still want to buy them. I've just slowly decreased my risk over time because I have more money in the portfolio. Whenever I feel like they're a good value, I still pick them up. They're just very volatile right now, so I think that they'll still do well over the long term, and I want to invest more in them, but I found some other great companies too, so that's why I don't have them weighted as heavily as before. I think Amazon is a good value. I decreased my target weighting on them just because I have bought kind of about the same. The price that I've bought at is about the same that they're at now. They don't move down quite as much as some of these other companies, so I bought them, but I am buying other companies a little bit more now. But I think they're going to be good over the long term. They're a solid play. NRZ, I'm trying to increase my position in here because they've gone down so much. I think that they're irrationally priced right now. Like, I am down 61%. I think that is weighted for whenever I invested in them. So I don't think that I'm actually down 61% of whatever money I put in. Yeah, it says 112 and I still have 128. So I'm probably closer down to 45% down or 40% down, something like that. But I think that they'll do fine. They've started to rebound a little bit, actually. They were down more than this. But that's why my actual percentage is lower. They're probably one of the highest, or one of the companies that's done the worst, if not the worst, I think, actually. But their mortgage REIT, I think they'll do fine. They just have a high yield, and they kind of get hit with those lower interest rates, and that hurts them. Delta Airlines, I've decreased my position here too, but I'm still buying more, buying the dip. But I think they'll be fine overall long term. Disney has gone down a lot too. So they've gone down a lot for one of these bigger companies. But part of that is just because they have pretty much everything shut down. All their parks, all their cruise lines, all that is shut down. And a lot of these companies didn't expect to not be able to make any money for months on end. Like, even if they do poorly in a quarter, they expect some revenue. This is unprecedented right now, so it's hurt Disney especially because they still have a lot of those long-term expenses, but don't have any revenue coming in from parks and cruise lines and stuff like that. But their Disney Plus platform, their streaming service, I think will do pretty well over this time span, and then once I open up the parks again, people will start coming back, and it will be business as usual after a little while. So I think that they'll be great in the long term, and we haven't seen a dip like this in their price in a while. So Wynn stocks, Wynn Resorts, they are a resort chain or a hotel chain that works in the more expensive space. They have properties in Macau, in Vegas, and Boston, and they are hit really hard right now because of the shutdowns and everything like that. They had to shut down their hotels, but just their asset value is 3 or 4 times what their market cap is right now. So if they sold everything off, they could make a lot of money. And I think that they're irrationally priced right now too, just because they're going to have a terrible quarter. So I've started investing a little bit in there. Google, another long-term play, good company. AT&T, they're getting to have a really high yield right now. So I put some money in them too. They're rolling out 5G this year, so I think that they'll be fine later on. So as you can see, I've diversified more now. I have 17 holdings now, and about 30% of that are in these companies that either are just a collection of huge companies, or they own a ton of companies themselves in Berkshire Hathaway, Vanguard Real Estate, and Invesco. I think that this portfolio will still do great over the long term. In the short term, it's gotten hit hard, but that's what I expected, because these are a lot of the at-risk businesses between Carnival and Delta and Disney and the resort chain. I think that this is a higher risk portfolio, but I'm willing to take the risk because I think that these companies will do great in the long term. If you guys like this kind of thing, let me know. I appreciate it. Like the video. Let me know what you're doing. If you're holding on to reserves, waiting for the dip to go down a little bit more, or if you've been investing during this whole time. I appreciate it, and I will see you in the next video. See ya.